$100,000 in the bank pays you $300 a month. The same money in the S&P 500 pays you about $100. The same money in the right 5 REITs would pay over $10,000 to $20,000 a month. In this video, John takes that $100,000 and runs it through 5 of the strongest REITs on the market. 1 pick per category: net lease, cell towers, storage, data centers, and industrial. We'll cover the numbers behind each one, the trade-offs, and the role each REIT plays. Plus, I'll show you one REIT that's projected to pay John over $20,000 every single month in dividend income. And in the end, I'll show you a REIT that turns the same $100,000 into a $6 million portfolio that pays over $11,000 in monthly dividend income. So before we get into the picks, quick groundwork, because a lot of people hear REIT and assume it's just another stock. It's not. A REIT, Real Estate Investment Trust, is a company that owns income-producing property: warehouses, cell towers, storage units, data centers, apartment buildings. And here's the part most people miss. By law, REITs have to pay out at least 90% of their taxable income to shareholders. That's the rule that makes them exist. That's why REIT dividends look the way they do. The S&P 500 right now yields about 1%. REITs across the board pay anywhere from 3 to 6%. Some go higher. Now, a quick note before the numbers. These projections assume John's holding everything inside a Roth IRA, so the dividends and growth compound without tax drag. Outside of a Roth, REIT dividends are mostly taxed as ordinary income, and the long-term math looks different. Okay, that's the setup. Let's get to the rules John used to narrow this down. 5 filters for choosing these REITs. That's it. The REITs must have a current dividend yield above 1.5%. It has to actually pay. A track record of growing the dividend over the last 5 years, or a clear reason why it hasn't. It must be the dominant name in its sector. It has to have institutional ownership close to or above 80%, meaning the big money has already done the work, and we can only have 1 REIT per category, no overlap. The last one matters. A portfolio of 5 storage REITs isn't diversified. It's 5 bets on the same thing. John's picking 1 warehouse name, 1 tower name, 1 storage name, 1 data center name, and 1 retail name. 5 different jobs, 5 different sectors. And here's how they line up. The first REIT on John's list is Realty Income, ticker symbol O. People in the dividend world call it the monthly dividend company because that's exactly what it does. It pays every single month. What does Realty Income actually own? Over 15,000 commercial properties leased out to companies that have to keep their doors open no matter what's happening in the economy. Stores like Dollar General, Walmart, 7-Eleven, Walgreens, convenience stores, pharmacies, grocery chains. Boring businesses on long contracts, usually 10 to 20 years, where the tenant pays not just the rent, but the property taxes, insurance, and maintenance on top. That's what triple net lease means. The tenant covers everything. Realty Income just collects the check. And here's the part that says everything about the company. They've raised the dividend 133 times since going public in 1994, including 113 consecutive quarterly increases. The numbers? Right now, O is paying a 5.23% dividend yield. The dividend's grown at a 5-year compound rate of 3.53%. And the share price has been creeping up at just 0.75% a year, which tells you exactly what this REIT is and isn't. It's not a growth stock. It's a paycheck. So what does that paycheck look like over 30 years? After year 1, John's $100,000 in Realty Income would grow to $105,980. After 10 years, $190,986. After 20 years, $434,048. And by year 30, projections show that $100,000 valued at $1.23 million. That's a $1.13 million gain on a single one-time investment. Of that $1.13 million, only $84,000 comes from share price growth. The other $1.05 million comes from reinvested dividends. Almost all of the growth is the dividend doing the work. By year 30, the annual dividends are projected to be $127,295, or $10,608 a month. One REIT, one job, done well. Next on the list is American Tower, ticker symbol AMT. And if you've never heard of it, that's kind of the point. Most people haven't. But every time you make a phone call, send a text, open Instagram, or stream anything on a 4G or 5G signal, the signal probably passes through one of their towers. American Tower owns nearly 150,000 communication sites globally as of the end of 2025. Cell towers, broadcast towers, rooftop antennas, distributed antenna systems inside stadiums and office buildings. They lease that infrastructure out to carriers like Verizon, AT&T, and T-Mobile. And here's the thing about cell tower leases. They're 5 to 10 years long with built-in annual price increases baked into the contract. So the rent goes up every year automatically. The carriers can't really leave either because moving equipment to a new tower is expensive and disruptive. Once a carrier's on a tower, they tend to stay for decades. That's why AMT has been able to grow its dividends so consistently. The current yield sits at 3.89%, lower than O, but the 5-year dividend growth rate is 8%, and the share price has been appreciating at an average of 5.73% a year. So you're getting less income today, but a much bigger growth engine running under the surface. Run those numbers across 30 years, and the picture shifts. After year 1, John's $100,000 in AMT would grow to $109,620. After 10 years, $260,367. After 20 years, $747,799. And by year 30, that $100,000 is projected to be valued at $2.43 million, almost double what Realty Income delivered. Of that $2.33 million in gains, about $1.1 million comes from the share price growing, and $1.22 million comes from reinvested dividends. Way more balanced than O. The stock is doing real work alongside the dividend. And by year 30, the monthly check is projected at $13,317. So a higher monthly income too, even with a lower starting yield. That's the thing a lot of investors miss. Higher yield doesn't always mean more money in the long run. Growth matters just as much as the starting number. 2 REITs down, 3 to go. Next, I'll show you a REIT that pays over $20,000 in monthly dividend income. And in the end, I'll show you a REIT that turns John's $100,000 into more than $6 million, paying over $11,000 in dividend income every month. The third REIT on John's list looks weak on paper. 0 consecutive years of dividend growth. That's the stat most people see, and that's where most people stop looking. Here's what they miss. In 2022, Public Storage sold its 41% stake in a company called PS Business Parks to Blackstone for $2.3 billion. And instead of keeping that cash, they handed it straight back to shareholders as a one-time $13.15 special dividend. Then, in early 2023, they raised the regular quarterly dividend by 50% from $2 a quarter to $3, and they've held it flat there ever since. So when you see 0 consecutive years of growth, what you're really looking at is a REIT that raised hard and then held the line. A pause after a big jump. Now, what does Public Storage actually do? Well, they're the biggest self-storage REIT in the world, over 3,000 facilities across the U.S. And here's the part that's almost counterintuitive. Self-storage tends to hold up well in downturns when other real estate sectors struggle. That's because when people downsize, they need somewhere to put their stuff. When they move in with family or change jobs, they store. Self-storage is one of the only real estate sectors where economic stress actually helps the business. The numbers right now? PSA is paying a 3.93% current yield. The 5-year dividend growth rate is 8.45%, and the share price has appreciated at an average of 4.84% per year. Solid across the board, nothing flashy. But here's where it gets interesting. After 1 year, John's $100,000 in PSA would grow to $108,770. After 10 years, $247,211. After 20 years, $730,551. And by year 30, that $100,000 would be valued at $2.77 million. The monthly dividend by year 30 is projected at $21,899. $21,899 a month from one REIT and one-time $100,000 investment. That's more than some American households earn in a year, every single month, for the rest of John's life. Out of the $2.67 million in total growth, about $950,000 comes from share price growth. The other $1.72 million comes from reinvested dividends. So if PSA is paying nearly $22,000 a month, what's the next REIT even supposed to do? That's where it gets interesting. So this is going to look like a step backward, but it isn't. This is Equinix, ticker symbol EQIX. And while every other REIT on this list owns physical, traditional real estate, Equinix owns something most people don't even think of as real estate: data centers. Equinix runs over 280 data centers across 77 markets. These are massive, climate-controlled, fortress-grade facilities full of servers, the physical buildings that make the internet possible. Every time you send a Slack message, stream a movie, query an AI model, run a cloud app, or load a website, that data is routing through someone's data center, often Equinix's. And the demand isn't slowing down. AI alone is driving a level of data center build-out the industry hasn't seen in decades. Some estimates put data center capacity at doubling every 4 to 5 years just to keep up. So why is this REIT lower on the income list than the storage one? Because Equinix is built differently. The current yield is at 1.91%, the lowest on the entire list, but the 5-year dividend growth rate is 12.24%, and the share price has been climbing at an average of 11.77% a year. That's the engine. Most of the return isn't coming from the dividend at all. It's coming from the stock itself. So here's what that does over 30 years. After 1 year, John's $100,000 in EQIX would grow to $113,680. After 10 years, $361,745. After 20 years, $1.32 million. And by year 30, that same $100,000 is projected to be valued at $4.85 million. That's almost double what PSA built, bigger than AMT, bigger than O. But the monthly dividend by year 30, that's just $7,767. Still a solid income, but less than every other REIT on this list, except Realty Income. That's the trade. Because of how the math worked out, of the $4.75 million in total gains, over $4 million came from share price appreciation. Only about $730,000 came from reinvested dividends. The wealth came from the stock, not the dividend. So you've got two different jobs being done by two different REITs. PSA built a $2.77 million account, paying almost $22,000 a month. EQIX built a $4.85 million account, paying $7,700 a month. Both are right, both are valid, they're just doing different things with the same $100,000. Which brings us to the last one. One REIT on this list builds the biggest account. One REIT pays the biggest check. The last REIT does both at the same time. This is Prologis, ticker symbol PLD, the largest industrial REIT in the world. Here's what they own. Every time you click Buy Now on Amazon, every time a package shows up at your door, every time a Walmart shelf gets restocked, the product was sitting in a warehouse somewhere before it got to you. Prologis owns more of those warehouses than any other company on the planet, about 1.3 billion square feet across roughly 5,900 buildings in 20 countries. Their tenants are basically the entire global supply chain: Amazon, FedEx, UPS, Walmart, DHL, Home Depot. If a major company moves goods at scale, they probably lease space from Prologis. And here's why that matters. Industrial real estate has been one of the strongest real estate sectors of the last decade. E-commerce growth, supply chain reshoring, and just-in-time inventory pressure have all driven warehouse demand to record levels. The leases are long, the tenants are massive, the cash flow is durable. The current yield is 2.93%. The 5-year dividend growth rate is 11.59%, and the share price has appreciated at an average of 11.93% a year. Here's what the projections look like for Prologis. After 1 year, John's $100,000 in Prologis would grow to $114,860. After 10 years, $398,114. After 20 years, $1.57 million. And by year 30, that $100,000 is projected to be valued at $6.15 million. That's the biggest account on this entire list, by over $1.3 million. And the monthly check by year 30 is projected at $11,881, more than EQIX, less than PSA, but more than triple what most retirees pull from any traditional investment. Of the $6.05 million in total growth, about $4.93 million comes from share price growth and $1.12 million comes from reinvested dividends. This is what makes Prologis different from every other REIT we covered. PSA wins on income. EQIX wins on account growth. Prologis is the only REIT on the list that doesn't have to choose. If you've been watching this thinking, well, I want both, I don't want to choose between income and wealth, well, that is exactly where Prologis lands. Now, what if you don't have $100,000? I got you covered. Click the video on the screen to see how just $10,000 in the 3 best Fidelity Index funds could turn into a $7,000 a month portfolio.